Disclaimer. This presentation is not investment advice. This is not an offer to buy or sell any security. The information contained herein is believed to come from reliable sources, but we can make no guarantee of its accuracy. Please review our disclaimers and terms of use/service at our website. investwithwillow.com/disclaimer.
All right, welcome everybody. This is our July update on crypto. I'm Paul Farella. And we're gonna dig into some things today. So first, we're going to cover recent events, recent contagion, different things you may have seen in the news, and give our take and insight on that. Talk about the recent drawdown in markets as a whole, and sort of how we view all that in a bigger picture. Really, and then go from there. Maybe talk about how we've repositioned the portfolio a little bit to adjust, and maybe hit on some other news items that we found interesting. All right.
Okay.
So where to start? I'm sure you've heard recently about different firms or these lending entities, places that were advertising 8, 10% interest on your dollars. Now they're going belly up.
Yeah, so I'm going to just step back, and then maybe I can ask him some questions to answer for you. So yeah, that would be good.
Mm-hmm.
So you all know that there's been a big correction in cryptocurrency, and of course, coming into question is how viable is this asset? What should we expect going forward? Where's the problem? Is it the whole sector? Is it pieces of the sector? And where's the problem? So, and then of course, how secure is the money, your money, let's say at the, let's call it a clearing firm, a custodian agent, so to speak. So this is what we want to address today. And Paul definitely has a lot of insights here. So let's start here. Paul, let me ask you this. What exactly is happening? We've seen a very big correction in the cryptocurrency space, in Bitcoin, and Ethereum, and in many of the other small ones. I was saying a little bit like just reflecting from a historically and what we've talked about in the past, when the tech boom came in the 1990s, in 2000, if you remember, there was a tech bubble and we had a big crash, and many of the bad players went out of business. And we're talking many. There were thousands of internet companies that went out of existence. And if you know, many of the good ones, like the Googles and the Microsofts of the world, continued along only to reach significant highs. Okay. So what I want to understand is exactly what's happening here. It seems to me like they're throwing the baby out with the bathwater. Now, maybe I'm wrong, but I'm not, but let's just address it to you. Tell me a little bit about exactly what's happening there.
So the overall, sort of zooming way out and looking at the complete picture, crypto reached a $3 trillion market cap.
That's
overall.
huge.
Since then, as of today, it's like right around 1 trillion. So $2 trillion have disappeared or evaporated. Right now, you might think, "Oh my God, like what asset would do that?"
Well, the markets
did too, right? You have to look at these things as a whole, where there's this bigger macro picture that is going on, arguably having a much more direct impact on these markets than any one event or one-off thing. Companies like Zoom, PayPal, Roku, these kind of high-flying tech stock companies, they're also down 70 to 80+% from their highs, compared to Bitcoin currently is down 70% from its high, and Ethereum 75%. So it's right there with the highly speculative technology stocks. Sort of the shift. I don't know how far down this rabbit hole we want to go, but the shift in monetary policy from cheap money to now expensive money via the rising of interest rates really affects these types of speculative plays or more risk-focused plays.
Yeah. Rising interest rates really will be a party buster, so to speak. That's taking away the punch bowl at the party when they start to raise interest rates, and that happens in the more speculative assets. And as you know, we have said this is definitely a speculative group. But again, in all speculation, just like I was saying to the tech bubble, We have many companies that were down 90%. Many went bankrupt. Henry, WorldCom, the bad players went bankrupt, and the ones that were viable stayed. So what we want to do now is to give a little bit of context. We know some of these bigger places, bigger cryptocurrencies that we still believe in are dead. So what happened, Paul? Why? What led to the crash? Besides the Fed raising rates,
So
where is it being affected?
So other than the macro stuff that's all going on in the background, there is a ton of leverage in this place, and you have these
like market in the market.
You have this group of players called CeFi, or centralized finance. You can look at them as traditional financial companies or fintech companies that are familiar on the front end. It's very familiar, like logging into a bank or a brokerage account or whatever. But the back end of it taps into DeFi, decentralized finance, different protocols that are all on chain. The problem. So first off, I should say, during this $2 trillion in liquidations and downward draw, these DeFi protocols worked flawlessly. There was not one hiccup along the way in any of them. It's fully transparent. You can read into the code on these things and really understand what's going on the protocol level. It's not obfuscated in any ways. It's all right there. The code is very transparent. And in times of market stress, which arguably markets have been quite stressed in the recent past, they performed exactly how they were designed to. Now, one of the reasons this is a big problem is these CeFi players, right? These centralized finance players. So
not the DeFi players, the centralized. They're both in finance, so they're both lending out.
Right.
So okay. So
the issue comes in that these CeFi players are very opaque, meaning that you give them your money and they say, "Oh, we're going to pay you, whatever percent return," but then you don't actually know what they're doing with your money. Okay, and this is where this whole idea of contagion happened, where you had one or a few bad actors who, for whatever reason, took out obscene amounts of loans. All these different lenders were loaning to this group called 3 Arrows Capital, a couple other ones, and then they failed to pay.
Okay, so let me back up for a quick second. So I just want to make this a little granular. So Paul was saying in the DeFi space, the decentralized finance space, they performed the way expected. It's very transparent. Okay. Now he's talking about the CeFi space, which is the smaller players who are more leveraged in our life.
It's instead of me using my on-chain wallet, interacting with a protocol and knowing exactly what's going on. Yeah. I'm giving my money to a lending or a third party, a lender.
And keep in mind, during this time period, there were a lot of these small companies, these small lenders coming up in this CeFi space. Okay, that
Celsius, BlockFi. There's a whole bunch of different companies that
we wouldn't
operate
touch
in
with
the
a 10-foot
space.
pole.
Right.
Yeah, we would not. We didn't touch them with a 10-foot pole because there was no transparency there. Okay, so we want to make sure you got that. Okay, so
these companies, these CeFi companies, are then taking customer funds and loaning it out to third parties, executing very poor risk management. Or since there's no transparency, they almost had like carte blanche to do whatever they wanted with the money, with regards to who are they lending it to, how are they speculating with client assets to reach that return that they're promising to give.
So you know what? I want to liken this for those of you who were around in the financial crisis. I want to liken this to what we experienced with the credit default swaps, right? So you saw lending, but somebody was borrowing and then they were borrowing and borrowing and borrowing and borrowing. And so that at the end of that whole thing, you really ended up with nothing. Okay, really ended up with nothing except the Fed and the government basically backstopped all of this to stop the flow out, because it would have led to a big collapse in the entire financial system. This is a little bit different. This is a segment within the crypto space that's being affected, but again, it's affecting the whole because of perception, and also there was probably some lending with some institutions that were a little bit more viable.
Right, and one of the major issues here was that these companies were making loans with zero collateral or very little collateral, or they were using crypto as collateral. And if the price of crypto drops
Just like a
70%, right? Then a margin call happens, and they have to pay. The debtors have to pay to reaffirm their loan, right? And so it was sort of like a double whammy at once, where prices were dropping in the crypto assets, which caused margin calls, and then these, some of these lenders essentially just defaulted and said, "Well, we don't have any funds to pay." And so now you have these CeFi companies who've made all these loans. They're not able to collect on their debts, and now they're freezing withdrawals so that customers can't remove funds, or it's just insolvency. All these issues are popping up because of that.
So that's really a big. So again, to Paul's point, in order to meet their obligations, they have to liquidate the more viable, cryptocurrencies such as Bitcoin and Ethereum. And that's what, again, a rising tide raises all ships, just in any market. Those of you who've worked with us for the last decade and me for the last 3 decades, rising tide raises the ship, lowering tide lowers the ship. Once you see the wreckage, what you want to know is what comes out of that wreckage. Mm-hmm. What is going to be the viable investments coming out of that wreckage? So is there more you want to explain about what's happening?
Just that, this is a perfect example where regulation is a good thing, where these CeFi lenders, there's very little guidance, very little regulation around how they're supposed to operate. But that regulation then should be very much more thoughtful in how it spills over to the actual protocols, because the protocols, what's happening. You get full transparency where your funds are moving, how they're being used. They self-regulate because it's code. It's all code, and you know what to expect. The CeFi guy, you don't know what to expect. You don't know what they're doing behind the scenes. There's no transparency.
But I want to point something out here, because I think this is really important. Something that Paul is talking about is that in DeFi, it's all code, so it's all there. It's transparent. Now, we don't have that in our traditional banking system. You don't know where your money's being lended. So even in a system that is regulated, we literally had a problem in 2017, 2018, where we were looking over the cliff of potential default. So just to put this in context, even in a regulated industry, there was overborrowing. If you remember, subprime and lenders were lending upon lending. In the credit default swap area of insurance, it was insurance over insurance over insurance, AIG almost went bankrupt, right? So even there, in a regulated industry, it literally happened. If there was no backdrop, those would have been gone. Mm-hmm. There's no question in my mind.
Right. So to hammer on this point, you look at you go to your bank and you deposit funds. Now, I think the reserve requirement is actually 0.
I don't know. They keep lowering it. Yeah. So, but I don't think it's 0. Is it pretty close? Sure. Oh God, I don't know.
Yeah. But at the end of the day, you loan, you deposit your money at a bank, and then that bank is essentially loaning that money out, or creating but loaning that out, and you don't really know who they're loaning it to. No, you don't know how those funds are being used, but you do have some assurances through FDIC or different types of insurance on it. You don't have those kind of insurance in the crypto space. Although there are crypto insurance you can get on protocols, but that's a whole other conversation. But ultimately, if the bank makes bad loans and they can't be paid back, the government or whoever can step in. Now that's never been tested at scale, which is concerning.
Yeah, but okay. So Paul, let's keep going. So we know that the CeFi space was affected, and in turn that created like a contagion, like a rollover effect in all these other areas. So Paul, what about the viability then of some of these, let's call them custodial agents? Like, how would a Gemini or a Coinbase or some of these other companies, how would they potentially get pulled into this?
Yeah. So if they decided these custodians arguably operate on a higher security standard, have higher due diligence, because many of the custodians actually do follow or get more licensing and things necessary than these CeFi firms. So they have a lot more regulation, a lot more rules that they have to follow. So they're more stringent in who they're lending to.
So we hope that they're paying attention to this.
Right. And
Now,
so
remember, banks in 2017 were not stringent about who they were lending.
there's still information coming out, so I can't say for certain that they weren't dealing with any of these super sketchy or super high risk loans. But so far, it does look like the majority of the exchanges you all know by name were not making these types of loans to risky ventures and VC funds and risky hedge funds and these kind of things.
We don't have any indication of it yet, but we are doing our due diligence to try to figure that out the best that we can, right?
Right. I think for this might be speculation, but companies like Coinbase have to disclose this stuff in there because they are a public company.
Exactly.
And none, they're still solvent currently. They're not freezing customer funds. That's sort of the number one telltale sign is if there's any inklings of, oh, are they going to lock my account or not allow me to transfer funds out of their platform? That hasn't happened yet at these custodians. So if this contagion from all these bad loans that went was spilling over into them, we probably would have seen it by now. I'm not saying that we're all in the clear yet, but it does look hopeful.
Yeah, at this point, there's some stabilization, but sometimes this is how it unrolls. You have one event like we had the beer stearns, and then months later another thing happens, which is why we're doing our due diligence to make sure that there isn't a problem. So this is what the current event is right now. So with that, Paul, let's talk a little bit about some of the developments that we are seeing in the Bitcoin space. For example, some big announcements that recently occurred.
Big announcement. So the BIS, or the Bank of International Settlements, which is enormous. It's sort of like the it's made up of 63 or something member banks, and those member banks are basically the central banks of almost every country around the world. So it's sort of like the top of the pyramid in terms of banks.
Paul, being very polite, top of the pyramid, meaning the big money, the money that controls a lot. Okay, let's just put it out there.
The thought leaders, they set the essential
policy makers.
They just issued a new internal research report paper that says they're highly considering and likely to add a rule that says their member banks can have 1% of their balance sheets essentially in Bitcoin.
And Paul, what is that number? Like around 1 trillion? Is that going to be around 1 trillion?
It probably.
Yeah, I think around what that would equate to maybe a little more. I'll look at that while he's talking because I think it's pretty.
Yeah, you're talking about the central banks of 67 different countries
that would
allow 1% of
their assets
to be in this asset.
On their balance sheet.
That's huge.
Yeah, that's big. That's not a small. Again, if it's not a viable asset, why?
Right.
Unless it's whatever.
So as we've said many times too, we firmly believe 95% of the cryptocurrencies and things you see out there are trash. They're garbage. They're scams. They're vaporware. They're cash grabs. But there is that 5% or so that is insanely disruptive technology that is going to change the course of the future.
Yeah. So I keep going back. Think of the internet. For those of you who were around, there were thousands of companies that literally went out because they were all grabbing for a new market. And, for a little while they were making it. And then, the Ponzi schemes went on. So that might be, maybe this is where we are. Maybe this will lead to thoughtful regulation, which is what we do hope for thoughtful regulation here. And
in that same light, there's a company, Grayscale. They have a exchange traded product that is a trust that owns Bitcoin, Ethereum. They have a couple other ones. They've recently just were trying to turn their fund from an ETN into an ETF. Were denied by the SEC, and so they're actually currently suing the SEC because of the lack of clarity and why. So, lawsuits to get policy or regulatory clarity. It's not the best route to do it, but unfortunately, policymakers and regulators have just really been dragging their feet, which is unfortunate because it's been stifling innovation essentially. So.
Yeah. I'm just trying to see what amount that would be. And Paul, let's talk a little bit about Paul gets on the calls with the developers for Ethereum to listen to how they're doing with their upgrades. So can you just give a little bit of update on that? So again, what does that mean? I just want to make sure you know. It means that he's not reading the news. It means he's not getting the information secondhand. He's actually going on to the developers and listening to what they have to say about what's going on.
Mostly developers have open calls. Anyone can join if they want, and you can hear about the progress and changes. So Ethereum is moving. This is probably the major news of 2022, assuming that this happens in the early fall. Ethereum is moving its consensus from proof of work to proof of stake. And in that process, ultimately it results in a 99.95% reduction in energy consumption to switch consensus mechanisms. It also significantly changes the issuance rate of Ethereum, so it's not an inflationary asset, and essentially just changes the structure, or the demand structure internally of how it works. So, you know, a lot of people have been naysaying that, oh, this will never happen, Ethereum's been saying it will happen for years, and it's taken, well, development takes a long time. And when you're playing with technology that trying to do things that have never been done before, putting a date on it is kind of foolish in the first place.
Yeah, same thing happened again with the internet.
Right.
It took a long time for that to come out.
These things take time. But it does look like all signs point to late September, early fall, Ethereum should be ready to make that pivot. And when it does, it should be a very positive thing for the environment of Ethereum overall, where it's no longer an energy consuming resource, and it's arguably, you know, there's some great arguments that it's potentially just as, if not safer, type of consensus mechanism.
Yeah, so I just looked it up. So the reserve, you know, we were just talking about the potential Bitcoin reserve would be 1.82 trillion in assets held on the balance sheet. Just from central banks. So anyway, do we want to open it up to questions?
I think that's a great idea.
Okay.
Oh, really quick too, for those of you who have accountants, we have pivoted the portfolio a bit. We've increased our cash a little bit. We do believe that the macro picture is still not conducive to being fully invested in these assets at this time, but it does give us some dry powder for when we see conditions change to be deployed.
Yeah, so just keep this in mind. Just like with the traditional investments that we do, we look at everything from a macro lens. So at the top, how do we see things going? Well, the Fed is raising interest rates, so that's a risk. There in and of itself is a risk off indicator to us. In addition, inflation is higher, which would tell we're talking about potential stagflation, which we already believe we've been there. That's also a risk off indicator. So even though we may like some of the micro pictures that are taking place, the macro tends to trump our direction. Okay, so keep in mind, that's why we said, okay, just a little off the table, a little bit of cash, so that maybe we might nibble on some other areas. So, okay, so I think that's good. So let's open it up to some questions. By the way, we didn't own any of our CeFis.
Yeah. So we did get a question that came in via email, and it was talking about how do these changes affect giving to nonprofits. So there actually are many, I'll call them recently crypto wealthy who've well, maybe not so wealthy anymore, but crypto wealthy who you know, we're looking for ways to lower their burdens, tax burdens. Probably with this type of drawdown, you might see less charitable giving because the disposable funds are no longer as disposable as they were. That would be kind of my take. When I look at what's happening too in the giving space, there's more and more companies popping up. I've actually had a conversation with a few recently who are building out the infrastructure so that it's very easy for nonprofits to accept cryptocurrency. You know, if I have my wallet, I have a bunch of crypto, I want to donate it. There's whole networks being built to facilitate that transfer of funds. So that's a really cool, positive use case for this technology.
I like that. Okay, so let's see, what else do we have? Do we have anybody who wants to ask some questions? Please type it in. You'll see in the chat box, you can type a question in there, or if you want, you can raise your hand. Can we see everybody so that we can see if anybody's raising their hand? Don't be shy, ask away. We like your questions. Let's see. No questions.
What else is happening in the crypto space? There's still lots of fundraising going on.
Yeah.
I'm on a couple of distribution lists that show me all the different capital raises for funding these projects. I mean, there's still obscene amounts of money going into this space. So backing up to, we are still extremely bullish, whatever, on the the underlying technology in the space as a whole, long term, right? We've always said short term, it can be crazy. Volatility should be expected.
No,
Volatility should be the expectation.
Short term mistakes.
Yeah.
Let's just
Suck short term, right? Nobody wants to see it drop down like this. But you look at the history of this thing, granted, it's only a 10, 12-year time frame. These are potentially the times to get involved, learn as much as you can, read up on it, and start to connect and like, oh wow, there is a much bigger picture here. Because really this technology is more than just replacing finance or replacing certain backends for technology. It's also a global coordination tool, and allows for an entirely new way for people to organize and coordinate around shared goals and shared ideas globally, which is just a whole mind-blowing thing. I'm not going to. That's for another time. We'll dive into that.
Okay. So it looks like I don't think anybody has asked any questions. Nobody's raising their hand. So I think we've covered it, I hope. And you know, of course, where to contact us if you have any questions. Please get in touch with us.
Yep. Email, call, feel free to reach out. We're here. We love talking about this stuff.
Yeah. So okay. Well, thank you, everyone.
Until next time.
We'll talk with you soon. Take care.